The top things to think about when transferring defined benefit pension scheme, explain. Okay, you have quite a big problem on your hands here, a bit of an issue. You have potentially a defined benefit pension scheme and you're trying to ascertain, should I keep it or should I transfer out? This is what all of the majority of our clients have been through, this decision process. Many of them have moved ahead with transfers, some of them have not moved ahead with transfers. So my job is to help you try to understand what you really need to be thinking about. And the reason this is so important, as you'll see on all of your paperwork and all of the scam guidance and everything from the FCA and the government, you are giving up a safeguarded asset, which has a defined income in your retirement, which is guaranteed to grow at the rate of indexation. So it is a very big decision in order to give this up. So you need to make sure you do things correctly. And in today's video, I will be explaining how to do that. Please like and subscribe below. It's genuinely the best thing you can do for me to let me know that my content's good and to help us out on YouTube. Okay, so the main thing that you need to consider when considering a transfer out of your DB scheme is why. It's the very first question any pension transfer specialist will ask you. Why are you considering to transfer out your DB scheme? If you say basic and generic things such as, oh, I've reached 55 and yeah, I just want to transfer it out because it's mine, a pension transfer specialist is not going to like you hearing to say that. It's effectively like making yourself sound like you're uneducated, you haven't done your research, and at the drop of a whim, you're just thinking, oh, I've got a $500,000 DB, I'd like to get it in a SIPP so I can do whatever I want with it. That is literally the last thing that any pension transfer specialist or any good pension transfer specialist wants to hear. What they want to hear is that you have a formulated plan. Say, hi, yes, the reason I'm considering transferring a defined benefit scheme is because I understand I'm giving up my defined benefits and safeguarded income. However, this is the plan I have in place for the capital, and this is what I cannot achieve inside my defined benefit scheme if I stay there. So for example, say you have £500,000 in your DB pension pot, and in your current account, you have £50,000. If you're sending your kids to university, maybe two of them in the space of a short period of time, you want to fund their tuition fees, you don't want them to take a loan, you want to do this, you want to do that, and the cost comes to £100,000, you can say, look, at this current moment in my life, I have a financial burden or responsibility coming up, and I would like to transfer out of my DB scheme to potentially access some of my tax-free cash or my taxed cash in order to pay this lump sum that I have coming up. It's a short-term thing, and then I want to leave the remainder of the capital invested to provide for my retirement. Now, that's not to say the pension transfer specialist is going to say, oh good, you're paying for kids' education, I'm going to rubber stamp this and say that you should transfer your pension. Absolutely not. 9 times out of 10, it is not in a client's best interest to transfer the DB scheme. So that's the first thing you need to do, is have a good formulated plan. Now, a lot of you are saying, well, is it my job to formulate the plan, or is that the job of a financial advisor? And that's a very good question. What you can do is, you might not have any idea yet whether you really want to transfer or not. You might not have put that much thought or effort into it, and you certainly haven't formulated a plan. Get in touch below them. You can get in touch below via Calendly or WhatsApp to have an informal conversation with myself. In the space of 5 or 10 minutes, I'm going to know almost instantaneously how strong your transfer rationale is to put towards the pension transfer specialist. Now, I might tell you straight away, actually, I think you have a very, very low chance of being advised to move ahead with a pension transfer. You may want to consider this before going through the entire process, because obviously the pension transfer specialist works on non-contingent basis for the advice report fee, which has to be paid irrespective of whether you move ahead with the advice or not. It's not to say that I can guarantee a transfer will go ahead or not, but I generally have a pretty good understanding. So that's very important, formulating the plan. The other really important thing you need to do is find a financial advisor that you can trust. Trust is a word which is thrown around a lot in the industry. And as many famous phrases, it takes however many years to build trust, and it takes one instance to lose trust. And in financial advice, this is never more true. You are effectively an information loss. You're a knowledge loss to your financial advisor. No matter how many of my YouTube videos you watch, no matter how many articles you read, no matter how many times you call the FCA and Money Helper, you will never fairly, you will almost certainly never understand defined benefit pension transfers as well as a financial advisor or a pension transfer specialist. So you need to make a judgment. Do you trust this person to look after your best interest? Have you checked out everything? There's actually a video called Top 12 things to check with your financial advisor, which my team can put on the screen here. It's basically a list to run through with any financial advisor that you're effectively interviewing for the job of being your financial advisor. That's what it is. It's an interview to look after your money and complete a pension transfer for you. You have to make sure you trust them. Because over the course of the next 5, 10, 15, 20 years, you will invariably be working with them and they will be giving you a lot of advice. You have to feel comfortable that they are giving you advice in your best interest and not in their best interest to put money in their pocket. Here at Cameron James, I mean, I've been doing this for far too long to let any type of advice go out of the door, which I don't think is suitable. And again, to clarify, we do not provide defined benefit pension transfer advice. We ensure this is outsourced to a pension transfer specialist to, again, create a Chinese wall system. Myself and my financial advisors cannot impact the outcome of the report. We can only put the best foot forward for you with your best transfer rationale in order to try to attain a positive transfer outcome. But as I said, in the majority of instances, it is a negative outcome for transferring your pension. Another thing that's really important to consider is performance, okay? If you are a conservative investor and you say, Dominic, I'm extremely conservative, but I want to transfer my defined benefit scheme. Instantaneously, I'm like, what? It just doesn't make sense. You can't be a conservative investor but want to give up your safeguarded income for life and go and invest it into the stock market inside your SIP. The two just don't go together. Of course, you could be a conservative investor and need to complete a defined benefit pension transfer for something such as ill health or serious ill health or bad debts or financial planning. That can happen, but as a general person, the two don't really go together. If you invest yourself inside a SIP and you invest cautiously, so maybe 20, 30% equity weighting with 70% fixed income, bonds, government bonds, etc., you're going to have a horrible level of return by the time you pay your SIP fees, by the time you pay your financial advisor fees, which might be 1, 2, 3% setup charge plus a 1% ongoing per annum. The outcome of your SIP is not going to be very good. In my opinion, you really need to be balanced or above. A balance is 3 out of 5, adventurous is 5 out of 5, a balanced adventurous 4 out of 5, to have any type of chance of outperforming your defined benefit scheme in the UK. Most defined benefit schemes in the UK are guaranteeing you 3, 4, 5, 6, 7% growth inside the plan or whatever indexation over RPI or CPI they have. Again, if you want to understand exactly what's inside your scheme, you can get in touch below via the Calendly or WhatsApp to have a conversation with myself about your scheme. But anyway, it's really important to understand that if you want to take a very low level of risk, you're probably almost certainly better off remaining inside something that gives you a guaranteed level of return. On the flip side of the coin, say you have a defined benefit scheme worth £500,000, your net worth is 10 million, and you have absolutely no need for the defined benefit scheme. You might say, Dominic, I want to pass it on to my kids and grandkids. I want to invest it 5 out of 5, be very adventurous, because I'm looking at their risk profile and not my risk profile. Now, technically, you're not really meant to do that with pensions. Pensions weren't introduced as a tax-free way for you to get around inheritance tax to pass it on to your kids, but that's the rules, and that's where we are at the moment. And a lot of my clients do use their defined benefit schemes to pass on to their kids. In that type of scenario, it can be argued that you don't really need the income from the scheme. As such, you can take more risk with it in line with the risk profile of your beneficiaries. Now, a pension transfer specialist would say, well, if you don't need it and you have 10 million in the bank, why touch it? Why take the $500,000? Because you're guaranteed to have a return. You have 10 million over there. You don't need to touch the scheme. So your why almost disappears because you don't have a why. Well, your why is you want to pass it on to your beneficiaries and you want to grow the capital, which is a good why in layman terms, but from a pension transfer specialist perspective, they would see that as a red flag. So say, well, you don't need to touch this capital at all. You may as well have the guaranteed income. Other things to think about in terms of that are important for defined benefit pension schemes also come down to cost. Okay, cost is extremely important in whatever you do, but in financial services, it is king. If you work with a financial advisory firm which has a very high cost underlying portfolio, such as a DFM, discretionary fund manager, coming in to manage the capital on top of the financial advisor, so you pay the financial advisor 1%, and the financial advisor advises you on a DFM who charges you another 0.7, 0.8, 1%, you're already nearly on 2%. By the time you pay the SIP, by the time you pay the platform, nearly 30, 40 basis points, you're getting on towards 2% for your portfolio. Now that's inside the UK. If you go outside of the UK, where commissions and bonds and exit penalties and back-ended trail exist, I've seen clients of defined benefit pension schemes with 4 or 5% cost per annum. It's hidden in the detail. Clients have absolutely no idea. There's so many clients come through to us, particularly with QROPs in the international market, where people have effectively been ripped off, in my opinion, in terms of their fees, costs and charges. You need to be very careful. Now, that is not to say that, oh, I don't want to pay any cost at all, because that's impossible. It's a professional service of delivering defined benefit, safeguarded advice, and the industry is shrinking. The pension transfer specialists that are left are getting rinsed on their PI insurance every year to remain in the market. So for example, here at Cameron James, the pension transfer specialist we work with has a fixed report fee of around £3,000 to £4,000, sometimes £5,000, depending on the size of your pension pot. At Cameron James, we have a 1 or 2 or 3% advice charge for doing the implementation of any transfer. We then have a 1% ongoing annual management charge. In terms of our portfolio, to give you an example, our balanced portfolio, which is 65% equity weighted, costs 0.28% per annum, mainly because we use lots of ETFs and passive funds mixed in with active management to create a lower cost portfolio. So 1% financial advisor, roughly 0.28 on our balanced portfolio, and then normally around 20 basis points for platforms such as AJ Bell or something like that. So you're looking at around 1.5% all in for your advice. And that's because we're not outsourcing your investments to someone else. That adds another piece of the pie where you get stiffed for charges, in my opinion. There's actually some very interesting things on Twitter. If you follow DFMs and look at their performance over a 5, 10, 15, 20 year period, invariably the majority of them have actually underperformed just investing in a tracker fund such as the S&P 500. So guys, there's a lot of reasons why you need to be very careful and do your homework and do your due diligence. If you want to have a conversation with myself or one of our senior financial advisors, you can go to the description below, pop me a WhatsApp message or book into the calendar link to speak with myself or one of our senior financial advisors, and we will help you go through this process slowly and gradually. Do not make rush decisions with your financial advisor. If anyone's ever pressurizing you, telling you to sign things straight away, sending you documents in the post, etc., if you've never had a Zoom call with them and you've seen them in flesh or you've met with them in person, I would always steer clear of these types of people. Be very careful with your defined benefit pension assets and make sure that you feel that they are putting the client first rather than themselves first. As always, take care with your UK pension assets.